Hey everyone, welcome back to Conviction Bet. Hope you're doing well. It has been a loud few weeks out there. The Fed has a new chair now. Gold is sitting north of $4,000 an ounce. And there's a wave of giant companies lining up to go public, with some strategists already muttering the words .com under their breath. If you've been watching the market grind higher and feeling a little uneasy about why, you are not alone. And that unease is actually a good place to start today. Because here's the strange thing. Roughly 6 in 10 American adults now own stocks. And for most of them, the core holding is the same S&P 500, and almost none of them realize how concentrated it has quietly become. We turned just by the S&P 500 into common sense, and somewhere along the way, we all stopped reading the label. So let me start with the loud number. Last year, the S&P 500 returned about 16% on price closer to 18 with dividends. Sounds like a broad, healthy market. It wasn't. Roughly 42% of that entire return came from just 7 companies. 7. And today, those same 7 names make up about a third of the whole index. The market tells a story about a strong, diversified market hitting new highs. The quieter, truer story is that buying the S&P 500 has become a concentrated bet on 7 stocks, and most people made that bet without ever deciding to. I'm JL Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. I'm going to convince you that the S&P 500 is not one thing, it's a label, and at least 3 very different products wear it. I'm going to answer a question most people never even ask. Why does the index go up over decades in the first place? And by the end, I'll make the case that the smartest version of US stock exposure might be the one that, on paper, has been losing. Let me start with the label. When you buy an S&P 500 index fund, you're buying a jar with 500 ingredients in it. But here's what nobody mentions. They are not in equal amounts. The standard index is cap-weighted. The bigger the company, the bigger its slice of your money. So when a handful of enormous technology companies get bigger and bigger, the index automatically shovels more and more of your dollars into them. Not because a human decided that was wise. Just because that's how the recipe works. The result, the 7 largest companies, the group people call the Magnificent Seven, are now about a third of the entire index. A decade ago, they were around 12%. Think about what that means for a second. You believe you own a broad slice of American business, but about a third of your money is sitting in 7 companies, all clustered around basically one theme. And look, those are extraordinary businesses. I am not here to tell you they're bad companies. But there's a difference between owning great companies on purpose and accidentally betting a third of your savings on 7 of them rising together. So here's the first thing that actually matters for you. If you own a standard index fund and nothing else, you've made a much bigger bet on mega cap tech and AI than the word diversified implies, whether anyone ever told you that or not. And if your gut says concentration in beloved names always works out in the end, let me take you back about 50 years. In the early 1970s, there was a group of stocks everyone called the Nifty 50. Blue chips, Polaroid, Xerox, Avon, Coca-Cola, IBM, the one decision stocks, people called them, because the only decision was to buy, you'd supposedly never need to sell. Institutions piled in at any price. By the peak in 1972, they traded at more than double the rest of the market's valuation. Then the bear market of 1973 and 74 hit, and in one famous line, the Nifty 50 were taken out and shot one by one. The broad market fell about 45%. The darlings fell far more. Polaroid lost 90% of its value. Now, to be fair, many of those were genuinely great companies, and someone who held the best of them for 25 years eventually did fine. The businesses survived, but the people who bought at the top waited a brutal decade to find that out. The lesson isn't that today's giants are doomed. It's that you can't lose. Owning the best companies is the exact sentence investors have believed right before they learned otherwise. Now, Here's where I want to teach you the single most useful idea in this whole conversation. The investors who run serious money pensions, endowments, the people managing billions, they don't actually spend most of their time hunting for the one stock that goes up the most. What they obsess over is something called the efficient frontier. Sounds academic? It isn't. Let me give it to you with a street vendor. Picture someone selling things on a corner. If all they sell is umbrellas, they make great money when it rains and nothing when the sun's out. Their income swings wildly. If all they sell is sunglasses, same problem, other direction. But if they sell both umbrellas and sunglasses, suddenly it doesn't matter what the weather does. Rain or shine, they make money. Their income gets smooth. Here's the magic of it. They didn't need to find a better product. They just needed a second product that does well at a different time. That is the whole idea. The efficient frontier is just the fancy name for the best possible mix of things that don't all go up and down at the same moment, the smoothest ride for a given level of ambition. Umbrellas and sunglasses are uncorrelated. When one sells, the other doesn't. And that's exactly what makes the pair so powerful. Two investments that are both good, but that zig and zag at different times will, combined, give you a smoother result than either one alone. Now, if that sounds too good to be true, let me give you the two people who proved it works. Ray Dalio, who built the largest hedge fund in the world, calls this the holy grail of investing. His finding, and the math backs him up, is that if you can stack up about 15 genuinely uncorrelated bets, you can cut your risk by roughly 80% without giving up any return. 80%. And his sharpest line is the one that should stick with you. Most people think diversification means owning a lot of things. It doesn't. If you own 10 technology stocks, you don't own 10 things, you own one bet 10 times because they all tank on the same bad day. Real diversification is owning things that are actually different from each other. And the man who turned that into a legend was David Swensen, who ran Yale's endowment. When he took over in 1985, it was about $1.3 billion. Over the next 36 years, he grew it to more than $40 billion, compounding at roughly 13% a year, beating the average endowment by about 3.5% a year, every year for 3.5 decades. How? Not by picking hotter stocks. He went out and found whole categories of investments almost nobody else owned, and because they were different, they didn't move with everyone else's portfolio. Better returns and a smoother ride at the same time. So the question a great allocator asks isn't just, is this a good investment? It's, does this do well when my other stuff is doing badly? And here's what it means for you. The goal was never to find the single best fund. It's to own things that don't break on the same day. And there's a quiet freedom hiding in that. If you own things that don't all suffer at once, you stop needing to predict which one wins. You stop having to be right about next year, about the Fed, about the giants, about the next crisis. You just need a handful of pieces that don't all fail on the same day. That's a far easier game to play than fortune telling. So, before we open up these funds and look inside, let me ask the question underneath this entire episode: why does the S&P 500 go up over decades at all? Because not every company is the same kind of animal. Roughly speaking, there are two types. The first type throws off cash year after year and grows it. Think of the great software and consumer businesses. Their cash keeps climbing, and that steady climb is what drags the index up and to the right over 20, 30 years. I think of those companies as paying a kind of rising coupon like a bond, except the payment grows. The second type is more like a commodity. Take an oil producer. When oil runs from $20 a barrel up to $100, they make money hand over fist. When it falls back to 20, they give most of it right back. Hold one of those across a full cycle, 10, 15 years, and you can end up roughly where you started. And here's the human reason that happens. On the way up, everyone crowds into the hot commodity stock at once. Buyers swamp sellers, and the price flies. On the way down, that same crowd runs for the same exit, and there's nobody left to sell to. The crowd that lifted it is the crowd that crushes it. Here's the punchline. An index full of the first type compounds. An index full of the second type just chops sideways for years. The S&P 500 has worked for decades because it is stuffed with the first kind cash machines whose cash keeps growing, and because the index quietly sheds its losers and adds new winners over time, so the weakest businesses shrink in weight or drop out entirely. So when you go looking inside any fund, the real question isn't how many companies does it hold? It's how many of them are cash machines and how many are just riding a cycle. So let's open up 3 of them. The first is a fund nicknamed the Cash Cows. It does something mechanical and kind of beautiful. It scans the 1,000 biggest US companies and simply buys the 100 that throw off the most free cash flow for the price. The 100 best cash machines, basically. As of the end of March, that screen had a free cash flow yield of about 6.4%. That's how much cash the businesses throw off, not a dividend you collect versus under 3% for the broad market. More than double the cash generation for your dollar. And here's why that matters. Profits on paper can be massaged by accountants, but cash in the bank is much harder to fake. Here's the part that makes the point. In 2022, when the broad market fell about 18%, the Cash Cows Fund finished the year basically flat, a hair positive, actually. A real cushion in a brutal year. But, and I have to be honest, because this is the whole game in the roaring years that followed, 2023 and 2024, when the giant tech names did the heavy lifting, it lagged well behind. By design, it doesn't load up on them. So it wins the ugly years and trails the euphoric ones. And I know what you're thinking. If it trails in the good years, why are we even talking about it? Because that's the trap. The Cash Cows Fund isn't built to win the race in a roaring bull market. It's the umbrella. It's the part of the portfolio that holds up when the flashy stuff falls apart. One honest caveat, it trades very actively with high turnover that can create a tax headache. So if you ever own something like it, it belongs in a retirement account, not a regular taxable one. What it means for you owning the Cash Cows isn't about beating the market every year. It's about being the thing that doesn't shatter when the market does. The second product is the same 500 companies, same label, just mixed differently. It's called equal weight. Every company gets the same size slice, about 1/5 of 1% each, and it gets reset back to equal every 3 months. Same 500 businesses, completely different recipe, and that one change does something clever. When a stock runs up and gets too big, the fund automatically trims it. When one falls and gets too small, it tops it back up. It's a quiet, built-in discipline. Sell a little of what's gotten expensive, buy a little of what's gotten cheap, running in the background forever. And there's a second way to see equal weight. In the standard index, those 7 giants are so big that the other 493 companies barely move the needle. Equal weight flips, that it's essentially a bet on the 493 catching up to the 7. If you think the giants stay on top forever, you don't want it. If you think the field eventually closes the gap, it's exactly what you want. For its first 2 decades, from its 2003 launch through about 2023, equal weight actually slightly beat the standard index. But the mega cap surge since then has flipped that into major underperformance over the last couple of years, as those 7 names ran so far ahead. What it means for you is simple equal weight, is how you own all 500 American companies without quietly betting a third of your money on 7 of them. The third product isn't the S&P at all. It's the small companies, the index called the Russell 2000. And it behaves differently for a reason worth understanding. Smaller companies borrow more, and much of their debt is floating rate. So when the Fed cuts, lower rates can reach their financing costs faster than they reach the giants that locked in cheap fixed debt years ago. That makes the small caps the most rate-sensitive corner of the market. From the depths of the March 2020 crash, small caps more than doubled over the following year as rates collapsed, stimulus poured in, and the reopening trade took hold. And they rallied sharply again around the 2024 rate cut cycle. what it means for you if you believe rate cuts are coming and coming without a nasty recession attached. The small caps are one of the most direct ways the stock market lets you say so. Now, here's where I have to complicate the beautiful theory, because this is the part the textbooks gloss right over. I told you the whole game is owning things that don't move together. The uncomfortable truth is that whether two things move together can change. The cleanest example most of us actually lived through was 2022. For decades, the rule was simple when stocks fall. High-quality bonds usually hold up or rise and cushion the blow. That's the whole reason the classic stock and bond portfolio worked. Then in 2022, both fell at the same time. Stocks down about 18%, bonds down double digits. The cushion vanished at the exact moment people needed it. The umbrella and the sunglasses both failed on the same day. Gold is the other one. For a generation, gold followed one simple rule. When safe government bonds paid more, gold, which pays you nothing, looked worse and fell. And then recently, it just stopped working. Last year, gold tore past $4,000 an ounce, up more than 50% at its peak, even while bonds were still paying perfectly good interest. The old rule said that shouldn't happen. Dryly. It happened anyway. Because the thing driving gold quietly changed underneath everyone. Real interest rates still matter, but they stopped being the whole story. Now, it's also the government's own finances. The deficit last year ran around $1.9 trillion, and gross federal debt. The broadest measure is now near 120% of the entire economy, plus central banks around the world stockpiling gold and a steady drumbeat of geopolitical worry. When that many forces line up, people buy gold, no matter what bonds are paying. And lately, a fresh inflation scare has handed them one more reason. And it happens inside the stock market too. Think about the steady, high dividend stocks people buy for income, utilities, real estate. For years, they traded like stocks on how the business did. But once enough people own a stock purely for the dividend, it starts trading like a bond, moving on interest rates instead of on the business. Same company, different behavior because the crowd holding it changed why they owned it. What it means for you, the smoothest portfolio isn't built once and framed on the wall. It's a relationship you have to keep checking because the market keeps quietly changing the rules. So let me bring this all the way home. The case for thinking this way is genuinely simple. You don't have to choose between owning America and protecting yourself. You can hold the standard index for the giants, the cash cows for defense, equal weight to sidestep the concentration, and the small caps for when rates fall. 4 products, 1 market, all pulling in slightly different rhythms. A smoother ride than any one of them alone. Picture it in a real moment. A scary month hits and the giants sell off, and the cash cows, full of steady cash machines, tend to hold up better and soften the blow. They're still stocks, they can fall hard too, but in growth-led sell-offs like that one, they've tended to fall less. Then the Fed starts cutting, and the small caps come alive and rip higher while the defensive stuff just plods along. No single piece is winning the whole time, and that is exactly the point. They take turns. The umbrella and the sunglasses doing their jobs on different days. Now, let me be straight with you about what this is and isn't. This is not the full Holy Grail, and it is not the Yale model. Those rely on truly different return streams, bonds, private deals, real assets, things that genuinely zig when stocks zag. These are 4 flavors of US stocks. In a real crash, they will all fall together just by different amounts. But it is the retail investor version of the same instinct. Stop pretending one cap-weighted fund is the only way to own American business and start combining sleeves that behave differently in different weather. And I know what the bear case is. Someone is going to say, Maurer, this is overthinking it. The plain index has crushed every one of your clever alternatives for 2 straight years. Equal weight lost. The cash cows lost. You'd have made more just buying the giants and going to sleep. And that is true. It is genuinely, completely true. And these aren't dot-com fantasies. Those 7 companies earn real money with profit margins that have run close to 3 times the rest of the market. But here's why the thesis survives it. Look at the last time this happened. From 1997 to 2000, the Giants beat the equal weight crowd by about 30 points, right up until the dot-com bubble burst. Then equal weight outran them by more than 30 points on the way back down. The lead the big names have built today is already a little bigger than it was at that peak. Now, the difference this time is real. These giants make actual money. They are not the pets.com of the late 90s. So I am not calling a crash. Carefully. What I'm saying is that the setup, a tiny group of names carrying the entire market, priced for perfection, is the exact setup that has humbled confident investors before. So let me tell you what I'm actually watching from here, because a thesis without tripwires is just a vibe. 3 things. First, the share of the whole market sitting in those top 7 names. When concentration this extreme starts to roll over, that's historically when the broad markets and equal weight begin to win. Second, the rate path. Right now, with inflation running hot, the market expects the new chair to sit on his hands, maybe even hike, but cycles turn. Whenever the cuts do eventually come, assuming they're not panic cuts in the middle of a recession, small caps are one of the more leveraged equity ways to play it. And third, the mood. When companies are lining up to go public at trillion-dollar price tags and everyone's convinced the giants can't lose, that tends to be late in the story, not early. None of those is a crystal ball. They're just the gauges I keep my eyes on. And if all of this sounds like a lot, here's the honest, practical version. You do not need all 4 of these tomorrow. If you own nothing but the standard index today, just adding one steadier sleeve, something like the cash cows, already changes the shape of your ride. You don't have to build Yale's endowment. You just have to stop pretending one fund is the whole answer. So here's where I land. The S&P 500 is not a strategy. It's an envelope. And what you decide to put inside it, that's the actual investment decision. The person who understands the cash cows, the equal weight, the small caps, and the plain index and chooses how to combine them is making a real choice. The person who just buys the standard fund and assumes it's diversified is also making a choice. They just don't know they made it. So before you buy the jar, read the label. Then decide what you actually want inside it. Anyway, that's this week. If you prefer to read, the show has a Substack called Quiet Velocity. Find it at quietvelocity1.substack.com. That's Quiet Velocity, the number 1.substack.com. And if you're enjoying Conviction Bet, subscribe wherever you get your podcasts. Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm JL Maurer. This has been Conviction Bet.